Good morning, everyone. My name is Dean Rogers, Senior Analyst with Kase & Company, and thank you for attending today's chat. Today we're going to go through some interesting stuff that I've been talking about and kind of promising for a few weeks now, and that is some strategies that I've seen deployed and used by other traders, both retail, corporate traders, institutional traders, and even myself, some techniques that I use. All right, let's go ahead and get started. I just want to review real quick. We talked about this a few weeks ago. The Kase StatWare signals and the signals that we see from KaseX and Kase Private Label. Now, the examples that I'm going to show today are going to be in Kase StatWare, but we also do some stuff, the same logic will apply with KaseX and Kase Private Label since their signals are derived from the underlying StatWare signals. So just, again, to go over these very basic signals, our entries for Kase StatWare, we have the S's and L's. We have both warnings, and then the first class and second class signals. S is short, L is long. Just the very basic premise of that is we're looking at various momentum indicators, a longer bar length, filter, swings, and bar patterns to derive those signals. So the whole point of the Kase Easy Entry System keys is that it looks at a lot of information and distills it down into a very simplified, color-coded L or S to tell you whether or not you should be looking to get long or get short. The signals that we use for exits are based upon momentum, our proprietary momentum indicators, Kase peak oscillator and KCD, so the Kase PO and KCD signals. We have a P and a K, which are pinpointed overbought, oversold signals. P stands for peak out, and K stands for KCD peak. And then we have our divergence lines, which right now is just showing as a line, but when we look at a chart, it will make a lot more sense. The divergence lines for the peak oscillator are green, and for the KCD are red. In our newest version of the indicators, which are out on NinjaTrader, and I'm actually going to show you guys on TradeStation today, which are still kind of in beta on TradeStation, but we'll have those out very soon. And then probably on multi-charts following that, within a couple weeks. We have these dashed lines and the gray P and Ks, and those are the signals that are weakened due to a close against the direction of the signal. For instance, if we have a bearish divergence, but the confirming bar for the divergence closes higher, so it basically closes against the bearish signal, that throughout our studies has shown, or empirical studies has shown, to be a weaker signal, doesn't perform as well, and therefore we make it dashed. Still a good warning signal, still something that we should take into account, but may not be something that we want to buy or sell the farm on. And then our stop systems, very simple, based upon standard deviations of momentum, or of standard deviations of the average true range, standard deviation of the average true range. We have a warning line, which is a red line, Dev 1, Dev 2, and Dev 3, which are 1, 2.2, and 3.6 standard deviations away from the mean. Now with KaseX, we have our entry warning signals, the yellow diamonds, or darts, and then we have our long and short darts. We have our momentum signals, and we break these down based upon whether or not they're divergences or the KCD peaks and peak outs. Into three different classes. We have strong, moderate, and weak signals. These are the arrows that will point up or down. Anything pointing down is a bearish signal. Anything pointing up is a bullish signal. And then, the unique thing about KaseX is it's got the bi-directional stops. So you'll always have a stop in the appropriate direction, where sometimes with Kase StatWare, you do not have your stops in the right direction because the moving averages that cause those stops to flip have not crossed yet. And so again, that's something we've talked about in the past in previous sessions that have been recorded and posted to the Kase StatWare website. So if you haven't seen that, you can catch that there. And again, I'm sure I'll show it in the future. I may even show an example of it today if we have time. And then we have our entry signals on, or our Kase Private Label signals. Kase Private Label signals are the exact same as KaseX. KaseX is on Bloomberg. Kase Private Label at this time is on NinjaTrader, but we will be expanding that to TradeStation e-signal and multi-charts very, very soon. So we've actually got the coding done. We're just doing some testing, and so we probably have, maybe another month or so before we'll have Kase Private Label out on some of these other platforms aside from NinjaTrader. But again, we have, the diamonds are the entries, the momentum signals are arrows, and then we have our bidirectional stops. Now, the reason that I'm showing you guys these, and we've talked about these in the past, I just wanted to kind of go over them again very briefly, because these signals can be used in combinations. As we have discussed, we're not big proponents of trading systems, or we haven't really done a lot of development on trading systems because there's various things that hold us back on it. We really believe in trading and reading charts and making discretionary decisions. But I understand that some people want to. We understand that people want to trade, either automated systems or some sort of system, or they, at minimum, you really want to just test an idea or a theory. And I see a lot of validity in that. And so a lot of what I'm going to talk about today are concepts that I haven't tested, and at some point I would like to test or back test just to see the validity of how well they perform. Not that I necessarily would build them into an automated trading system. And again, I have nothing against automated trading systems. There's just certain technical limitations that I have seen for the way that we teach people to trade that probably wouldn't always work well. Now, that doesn't mean that our signals aren't going to work well in a trading system. It's just what you are going to make of them. And so that's why I wanted to kind of give you guys what I see as the little pieces of a puzzle, the little tools. And I always talk about these things. We have all these little tools. We never just use one tool to do the job. We use many. And so all of these different signals, the entry signals, the exit signals, the stops, can all give us various indications of when to get in, when to get out, and we can test various combinations. And so what I'm going to talk about today are some of the combinations that I've seen that people have used or I have used successfully in the past. Now, one of the other things that I wanted to point out that people talk about is our momentum indicators, our momentum signals, the divergences, the peak outs, the P and the K, the KCD peaks, or the arrows in KaseX. And a lot of people ask me why we do not use those as entry signals. And these are the statistics. This is the study that proves why we do not use momentum signals alone as an entry signal. Now, what we did is, and this study goes back a few years, and we update it every couple of years. But what we look at first, or the first question that we really asked, was how well do indicators predict turns? So if I have a divergence, or I have a KCD peak, or a peak out, how often do we hit Dev1 or Dev3? Dev1 being a 1 standard deviation move of the average true range over the last 30 bars, or Dev3 being a 3.6 standard deviation move. Now, Dev3 is going to be the 99.999 percentile, so it is statistically significant when we hit Dev3. Basically, the idea is when you hit Dev3, there is very, very little chance the market is going to continue in your favor. Generally speaking, the market has turned at that point and is beginning to develop a significant move in the opposite direction. It may not necessarily be a trend change, but you may have more than just a basic correction in the opposite direction. So it's kind of the you got to get out stop level. So when we looked at this, we said, okay, well, if we have a signal on the RSI, it hits Dev1 70% of the time, and it hits Dev3 26% of the time. You can see the MACD and the stochastic also have about the same statistics. The KCP and the KCD are a little bit better, not much, but a little bit better. And so we kind of scratched our head a little bit here. I mean, we obviously have a better performance by about 4 percentage points on average, but really it wasn't enough to be statistically significant to say, hey, the case indicators are superior. So then we really started to look at and say, well, what if we hit a stop first? What if we hit Dev1? How often was that preceded by a divergence? So in this slide here, what we're looking at is when there's a divergence, how often does it hit Dev1? The second question that we asked, which is shown on this chart, is whenever there's whenever a stop is hit, how often do we know that that stop was going to be hit? How often did we know that there was a signal beforehand? So it's a much more important question, because if we have we want to make sure that we're not missing turns with our indicators. This previous slide here, this shows us that whenever we have a signal, they perform fairly well to tell us when Dev 1 is going to get hit. And, about 26 to 30% of the time, we have a statistically significant turn. Okay. Whereas here, we're really looking and saying, okay, well, when there's a stop that gets hit, when there was a statistically significant turn, how often do we catch it? Well, the traditional indicators, combinations of them, only caught about 50% of the turns. So you're missing half the turns, half the major turns. Whereas the Kase P on the KCD still catch upwards of 80% of the turns. So very, very big and significant change or difference between the traditional momentum indicators and the Kase momentum indicators. And that's not to disparage the RSI, stochastic, and MACD. I love those indicators. I use them all the time. I use them on a daily chart, every day on my charts. But this just really shows the Kase P on the KCD with their adaptable cycle lengths and variability to adjust to market volatility or changing market conditions helps us improve the performance of our indicators. Now, getting back to my original statement here, and this really relates back to this slide, whenever we have a divergence or a KCD peak or a peak out, you can see that only about, we usually have a Dev 1 move, but less than 50% of the time, especially for the divergences, do we have a Dev 3 move. And so really, the Dev 3 moves are the moves that are, again, statistically significant, and those are the points where we would want to get in or hopefully have been in the opposite direction ahead of time. So whenever, what this is really showing us, what this is really telling us, is that whenever you have a momentum signal, like a divergence or a peak out, an overbought, oversold signal, they're good to indicate that a statistically significant turn is about to take place, at least a 1 standard deviation move, which is big enough that generally speaking, most traders will want to be out of their trade or at least have taken some profit off the table. And then about 30% of the time, 40% of the time, you're going to have a turn to Dev 3. But that's not often enough to be reliable enough to say, well, if we have a bearish divergence, we should short the market. So that's one thing that I just want to keep in the back of your mind, because we're going to talk about that here in just a moment with one of the techniques that we use. Now, the DevStop follow-through is also something that we can use in combination with some of our techniques and ideas for maybe testing some performance or ways to maybe get in and get out of the market in an automated or at least a more trading-like black box system manner. And this is just, again, this is something we went over this, I believe, on September 3rd. And in these tables show whenever you hit a stop level, how often the next stop level is hit. So this is something that shows us, okay, well, whenever, like for instance, the table on the top, whenever Dev 1 was hit, there's an 82% probability of hitting Dev 2, a 72% probability of hitting Dev 3, and so on. Or if I've already hit the warning line, there's an 85% probability for Dev 1, a 70% probability for Dev 2, and so on. And that's when the daily and the weekly stops are in the same direction. The table on the bottom shows when the daily and the weekly stops are in opposite directions, meaning that one set of stops is long, the other set of stops is short, above or below the market. Statistics are about the same. So really, I look at it as once we hit one stop level, there's about an 80% chance to hit the next stop level and a 70% chance to hit the stop level beyond that, and so on. It's kind of roundabout. This is kind of rough guidelines for me. But this is something that gives us some confidence as we see a signal take place. Maybe we've gotten into the market. Dev 1 gets hit. We now know that where Dev 2 is and Dev 3 is, and we can plot Dev 4.5 and Dev 6. And so we can really see okay, these are our next targets. And that can be very useful for someone, especially if they're building some sort of trading system. Okay, so we'll go through this. We'll go through some examples, very basic examples, and this is something that we'll continue to build on going forward. I can't go through everything. You know, I've been doing this for 15 years now. I've seen a lot of different techniques. Some work, some don't, some I don't know. You know, we never really tested them, and hopefully in the future we will get that ability to test them. I wanted to remind everybody about our forum, kaseco.com/forum. So if you have anything that you want to post, any questions or anything like that, or anything you want to discuss, we have a couple of people in there talking about trading systems. So you know, please jump in there, and this is a great place. You know, we're just getting it started, so there's not a lot of information there yet, but let's hopefully be able to build it. And then, as usual, if you have any questions, you can always go to our website, kaseco.com, which is being redesigned. We should have a new website launch in the next week or two. And then Kase StatWare.com. The kaseco.com site will also include a blog. All these sessions will be posted there as a video blog. We're getting much more active with social media. So I'm learning all about Twitter right now. So anyway, if you guys want to join us there too, you can at Kaseco. And if you have any questions, comments, or you want to suggest a topic, please email me, dean@kaseco.com. So with that, let me go ahead and change over to my desktop. And we will start talking a little bit about what we're going to see, you know, some different techniques. Now, you should all be able to see my desktop now. If you can't, just let me know. All right, so I have Tesla up on the screen. And I was just kind of going through this morning looking for some examples and some things that I've been watching, Tesla being one. With this recent move down, I find them to be a very interesting company. And you can see here a few weeks ago there was a nice bearish divergence on the daily chart. Looking at the daily, you can do, you know, these techniques that I'm talking about really apply to just about anything. And the biggest thing is the multiple time frames, multiple bar lengths that we use. We've taught using 2 to 3 bar lengths when you're trading, so that you have your longest bar length, which usually we call the normal or the normal monitor. That's where you're going to be risking the most. And so in this pretend trade, our highest time frame, you know, our goal is going to be to scale a trade to the daily chart. And we want to hold a trade on the daily chart for a given period of time. So generally speaking, our daily chart is going to have the highest risk. Now, this is always one of the challenges with trading systems and different things, is using multiple bar lengths and multiple time frames. And that's one reason that we really haven't gotten too into it, is because a lot of our techniques, and what we feel is a lot of successful trading techniques, not just our own, revolve around the use of multiple time frames, multiple bar lengths, and engaging, you know, scaling your trades up and down between various charts. So that's a challenge because not a lot of platforms, at least that I have seen at this point. Now, I haven't delved too deep into it, so I might be wrong. And if I am, please let me know. But not a lot of platforms support a multiple time frame strategy where we would be able to scale trades up and scale trades down in an effective manner. So what we're going to look at here, one of the things that I really like, and this is the technique that I use for generally investment type purposes. And when I say investment, it's really something that I'm going to hold for a long, you know, hopefully for a few weeks, if not a few months. What I'll do is I will start off with my highest time frame. So right now I'm assuming I'm flat. And you know, I'm looking for some sort of signal. Now, usually I only buy, I don't short stocks, but this is a good example here. And this really works in either direction. So here we have a divergence on the daily chart. Now, the daily chart, if we were long, we would have been out of the trade. You know, generally speaking, whenever we see a divergence like this, we exit 80% of our trade. We pull our stop level into Dev 1. Dev 1 was actually hit on the confirmation bar, okay? So this bar right here, that is our confirmation bar, right? Because that bar is the bar that tells us that we have a swing high in price as well as a swing high in momentum. On the KCD here, it's a red signal. red line, so it tells us the KCD divergence. So at that point, we are out of the trade. And now we're looking to get short. And as you guys have seen in the past, the way that we look for short signals or short trades is we generally look for a first signal, which is this yellow S. Okay, I know it's really hard to see, and we're going to need to change that color. That is extremely hard to see. But that yellow S, and then that's our first signal. Then we're not going to short here. We're going to wait for a pullback that holds the previous swing high, which we get a little bit of a pullback here after this big down day. That obviously holds the previous swing high, and then we get our second short. So this is actually the point that we're shorting the market. Now, that's a long ways off. We've already let quite a bit of profit or potential profit go. So what I'm looking at here is I'm looking at my daily chart. This is in my pretend scenario here, my highest time frame, my longest bar length. So this is my goal, is to hold a trade, ultimately hold my trade on the daily chart where I'm taking the most risk. Now, if I want to time an entry on a lower bar length, when I get this divergence, that would be a great time to do that. So what I do, the technique that I'm showing here, and this is one that I really like myself, is to monitor your longest bar length, the bar length that you're really looking to scale your trades to and hold your trades on throughout perceived trends. And I say perceived trends because trends vary between different time frames. You know, I'm looking for trends on the daily chart. So I'm going to start monitoring the daily chart. If I see a bearish divergence or a bullish divergence, and I usually only do it with divergences. I don't, the peak outs and KCD peaks, I generally treat more as warning signals. The divergences I generally treat as exits, and so, or potential major turning points. Now, we saw the statistics. It's not always that case. You know, only 40% of the time are we going to hit Dev 3 and close beyond Dev 3. But again, we're looking for those instances. And so what I'm going to do is I'm going to drop down to a lower bar length or a shorter time frame, and I'm going to begin to time an entry short. I'm only going to look for a short trade at that point. I'm not going to look for longs because I have a signal that's telling me this market's going to turn, and more than likely that turn is going to be statistically significant. We've already hit Dev 1, so at that point we know there's about an 80% probability of hitting Dev 2 and about a 70% probability of hitting Dev 3 based upon our DevStop hit table that we saw earlier. So that's what I'm saying. We can combine multiple techniques to build a little bit of confidence. Now, I need to figure out what my lower time frame is going to be. So, and I kind of left this open-ended so that we can do that. So on the daily chart here, I want to use case bar charts on the intraday. I like case bar charts. Now, if I were doing this, you know, I usually we go by thirds normally, but you can go by, you know, fifths or whatever else. So if I'm trading the daily chart, or let's say I'm trading a 270-minute chart. Got to make this easy so I can do the math. And I want 2 lower time frames. Well, I'm going to do 270 divided by 3 is going to be 90, and the 90 divided by 3 would be 30. So my charts would be the 30-minute, the 90-minute, the 270-minute, where the 270-minute is my normal monitor, my highest time frame. Now, in this case, the daily chart, you know, we're looking at Tesla, so it trades for 6.5 hours a day. You know, we can look and do all the math and figure out how many minutes in a day, and then cut that in a third, and then start looking to see, well, what's the average true range on each, and so on and so forth. We can make this really complicated, in other words. Let's make this simple. What I want to do is I'm going to look at what the average true range on the daily chart is. All right. So I'm going to say insert strategy, or not strategy, insert symbol, or analysis technique. We want the average true range. I usually do this over 30 bars, a 30-bar average true range. And I just want to get an idea of what the average true range is over a statistically significant period of time, at least 30 days. All right. But I'm going to go back. Now, there's a little bit of art here. There's not a real science to this, okay? I'm just getting an idea. You know, we're looking at probably something that's 9.5 to 10 points on average, and I'm going to probably pick 10. Well, you know, we may even go down to like 9.5. All right, 9.5 points. That's kind of just in the center, you know, of the variations that we've seen. All right. over the last couple of months, or actually really almost over the last year, going all the way back into November of last year. So we're going to go with a 9.5 point range that we're just, getting it again. We're getting an idea that right now the average shoe range on the daily chart is about 9.5 points. It varies from about 7 to about 11. So we're kind of picking something right in the middle in there. Okay, so right around 9.5 points. Now, if I want to use a case bar chart, what I'm going to do is, let me copy my window here, and I'm going to set up 2 lower time frames, or 2 lower bar lengths. Okay, so we'll have our daily, which is our normal monitor, and then 2 lower than that. Now I set up a quick little spreadsheet this morning just to kind of cheat this out. And what I did was, if we're looking at, like we said earlier, if we're looking at the 270, 90, 30, we can look at, we're just dividing by 3, right? Or multiplying by 3. That's pretty easy. Now, something that we've talked about in the past is volatility is equivalent to the square root, or is related to the square root of time. So if we're looking at something that we want to have, if we want the factor to be 3, meaning that we want our lower bar lengths or our higher bar lengths to be 3 times the size, or 3 times the risk, more importantly, then we can divide by or multiply by the square root of 3. All right, so if I'm looking at a 9.5 point on the daily chart, if I want something a little lower than that, it's going to be about 5.5 points. If I wanted to go 3 times higher, 3 times more risk, it's going to be about 16.45. And we're not going to take 9.5 points times 3, okay, because risk is relative, again, to the square root of time. So we want something 3 times lower in this case, so we're going to use a 5.5 point. All right, so we're going to have a 9.5, 5.5, and again, we could use 5.48. That's fine. This is not an exact science here, guys. And then if I want something 3 times lower than 5.5, I can use something right around 3. I'm going to use 3.2. I'm going to round it to 3.2. All right. Now, we're actually our 9.5. We're going to stay on the daily. I like keeping the daily. I don't generally convert my daily charts into case bars. The reason being is the daily chart gives me a full cycle, and the daily chart is meaningful. It's a natural bar length, a natural time. And so you get an entire cycle of the market on the daily chart. And so I really like using and looking at the daily chart. But if you wanted to use the range, you could use the 9.5 point if you wanted to. Okay. So now I'm going to go to the 5.5 format symbol. We're going to go to the case bar. We're going to use a 5.5 point case bar. And then we're going to use a 3.2 case bar. All right. So now we need a little bit more data here. Let's go 100 days back. All right. So we had gotten our signal here on 9/5. That's when we had our divergence. Our divergence was confirmed. We hit Dev 1. We were out of any long trade. We are now looking short. We will continue to look for short trades until the swing high, the divergent swing high, which was 291.42. Okay, that was the high on the day that the divergence formed. The day that the divergence was confirmed, that was the day after. So until 291.45 is overcome, at least in the short run, okay, I'm looking to get short. Now, if the market turned right back higher, overcame 291.45, that negates this divergence, I can now look long again. But really what I'm going to be looking for is, where's my signal? So my signal in this case is the bearish divergence. We're going to drop down to our lowest bar length, our timing chart, and we're going to start looking on 9/8. Okay, on 9/5, it's already too late. We had to wait for that day to close. So 9/8, we're going to start looking to see where we get a signal. All right, so let's look back. Here's 9/5. Here's 9/8. So on 9/8, we had a long signal. Now we had short. Okay, first short. I know it's yellow and it's really hard to see. So I'll go yell at the programmers after a while. Tell them yellow's not good. I'm just kidding. You guys have talked to Carlos before. I won't yell. And then we've got our second short signal, the magenta colored. And so that, but that was on 9.5. You know, yeah, I could sit and argue that we took it then, but you know, on 9.5, we're really waiting for the signal to be confirmed. So I don't think I would have taken it because this is the end of 9.5. And you know, really at that point, we're still waiting to make sure that that divergence is going to get confirmed. We get a buy signal here, it's the first buy signal. Again, I'm not looking to get long. I'm ignoring the L's at this point. Here I have another second buy signal. It's pink, okay? We have a swing high that held the previous swing high. We held the 291.42 swing high here. So this actually is the point where I'm going to get short, right here. Okay, so I am short. I am now short on the 3.2 chart. My stops aren't in the right direction, or actually my stops, I'm not looking great here. Oh, actually, I know I need to here. Give me 1 second here. Let me put my correct stops on. Too many indicators. Okay, so Kase. All right, just to remind you guys, whenever we use any kind of range bar or case bar chart, any chart based upon price movement rather than time, we want to increase the standard deviations of the true range that we're going to be taking for our DevStop. So we use 2.1, 5.5, and 8.9. All right, so here we have our short signal. We've got our stops in place. I'm placing a stop at depth 3. I'm riding this move down. Now, you know, if we extrapolate depth 3 out here, you know, we held it. So we're okay with this little bounce, market's moving down. But one of the things that I want to show you guys is, okay, we might have taken some profit here on the 3.2 case bar chart. We have a peak out here that hits Dev 1, so we would have been out. We have long trades. We have a divergence. So as this move down has taken place, it's been pretty darn clean on the daily chart. We had this KCD peak, but otherwise it's been pretty darn clean as the move down has taken place. So now at this point, what I'm going to do is to avoid some of those whipsaws. What I'm going to watch is once I'm short on my 3.2, I am then going to watch my 5.5 case bar chart. Okay, and we were short on 3.2 or on 9.9. Okay, that's when we got short, was 9.9. So basically we were short on 9.9, and then on 9.10 on the fast monitor chart, we get this confirming short signal on the 5.5 case bar. At that point, I am now going to scale my trade to this bar length, to this higher time frame, so that I can avoid some of the whipsaws that are taking place on the 3.2. I don't want to get out prematurely. I now have permission, so to speak, on the 5.5 case bar chart to take more risk. So I'm going to scale up, and I'm going to, again, let me put in my dev stops here, my case bar dev stops. All right. I'm going to place, now the stops haven't flipped yet, okay, so here's a good example. Stops haven't flipped. I can either place my stop at the previous swing high of 291.45 or 42, or I can come in and I can increase or speed up my moving averages. So 5 and 8. They cross a little bit sooner. I now have my stops in the opposite direction, in the right direction. I have Dev 1, Dev 2, so I'm going to place a stop at Dev 3. And I'm going to begin to scale that or trade that, scale that move down. Now, again, same premise. We might have a divergence, or we have this weak divergence here. We can stay on this chart. Now, some discretion. See, this is where I like discretion, right? So on the daily chart, I'm going to be monitoring the daily chart to see if I get any confirming short signals. I do get a first-class short signal here. So I could theoretically scale up. Now, this might be an area where I ask myself, if I scale it up, when I get this KCD peak, I'll probably pull my stop levels in, tighten them up a bit, but we shouldn't be hitting Dev 1. We don't have Dev 1. I'm going to have to try to flip them here. Let's see if I can flip them in the right direction. Yeah. So we have this KCD peak. We might have hit Dev 1 right in here. Let's see, Dev 1 was 265.59. The high on that day is 265.60. So we could have gotten stopped out right in here. So, we could have gotten in short, scaled up to the daily chart, and then we have our KCD peak. We pull our stop level into Dev 1. We could even take some profit, but more than likely we'll pull stop level into Dev 1. We do hit Dev 1. We get whipsawed a little bit. But when we get whipsawed here, again, we're going to drop back down to our 3.5 point or 3.2 point, time our entry off of the high on 918. Okay, so where's our 918? So here was our 918 high. So we get our short signal and our second short signal. In fact, this is already a second short signal. We had a warning signal earlier. But if anything, we're going to get in again here on, right around 919 or 922. And then we'll scale our trade back up here on 922. Okay. Move this arrow. All right, so we would have gotten in short again here. And then we could scale up. And then ultimately on 922 on the daily chart, we get another short signal. So pretty much on 922, we could have gone right from the 3.2 all the way back up to the daily chart. Okay. The point of this matter is, the other thing that I could have done is I might not scale my trade. I will generally scale my trade even on a first signal. Okay. But you might have a rule in place, and this is something that I would like to test, so that I'm not just making judgments based upon, upon my own judgment, what I'm seeing on the charts, or empirical evidence. I'd rather have something that's quantitative. And so what we can look at is, maybe only scaling up when we get a first class or a second signal. Again, discretionary. But the whole point of this matter is we had a really nice little trade. Even if we got out on this KCD peak, we had a nice little trade down here that we were able to time an entry on early in this move, pretty much a day after the peak out confirmed. Whereas if we would have tried to time this entry on the daily chart alone, we wouldn't have gotten in until basically the point where we had taken a second trade. So we did get whipsawed here a little bit. It's going to happen from time to time. It's life with the markets. Every once in a while, it happens. If our stop had been a penny higher, 2 pennies higher, we wouldn't have gotten whipsawed. I mean, that's how close it was. So, this is a situation where you shrug your shoulders a little bit, you get whipsawed, it happened, we time an entry again, we were able to scale back up to the daily chart, and we're in good shape. We are short right now on, short Tesla right now. So that is one of my favorite techniques. We're running short on time. We're actually over time here. We're 9 minutes over right now. So we will go through some more techniques and various things over the next week or two in the next chat sessions. So if you do have any questions, please let me know. But just to recap here, the whole idea of this system is to find a signal, such as a divergence, that gives you a reason to drop down. Like for instance here, when we got this bullish divergence all the way back on 5/12, on May 12th. Now that bullish divergence actually would not have shown up until May 13th, when we had our confirmed swing low in momentum and confirmed swing low in price. At that point, I am going to drop down into my intraday charts or my lower bar lengths, time my entry, and then ultimately scale that trade back up so that I can hold it through this trend. The trade-off here, you're going to give up a little bit of, your entry might be a little worse. It could be better, but more than likely it's going to be a little worse than if you just started on your shorter bar length. So the way that we normally teach trading with StatWare is to start off on the 3.2, time an entry, scale it up to the 5.5, and then the daily, right, in this instance. However, a lot of times you'll get in on the 3.2, the market turns in the opposite direction, you're out. So you might have to take 5 or 10 trades on the 3.2 chart before you ultimately are able to scale it up to the 5.5 and then the daily. So you have a lot more trade, a lot more risk, or not risk, but you're gambling a little bit more in the sense that you're taking trade after trade after trade until you finally hit on the one that starts to move in the direction that you're getting your signals, and you get in on that trend. Whereas what I'm showing here is you're waiting for some sort of indication that the trend may turn, may be over. And so in this case, when we get that bearish divergence, now we have ample reason to drop into our lower bar length, time our entry in our opposite direction, and then begin to scale that trade up. All right. So if you guys have any questions, let me know. Please send them to dean@kasego.com. You can also send them into the chat right now. Next week, same time, same place, and look forward to seeing you guys then. Have a good day.